we had a decade to build this gigantic asset bubble on free money and money printing, and now it's the reverse. I mean, there's no way asset prices can withstand that. They weren't built for that, So yeah, I think stocks are going, at least in the U.S., which is what I follow. I think stocks are going considerably lower. I think we're just going to grind our way down, throughout later this year, maybe into next year.
On today's episode of the WTFinance podcast, it's my pleasure to welcome Mark Spiegel, who's managing member and portfolio manager of Stanphyl Capital Partners. And Mark, thanks for joining the podcast today.
Thank you for inviting me. I'm happy to be here.
No problem. And I'm really looking forward to our conversation. So I guess just to start off with, can you maybe give us an overview of your thoughts about what we're currently seeing in the markets in general?
Well, I think we're in a bear market. I think we just came off, as you and I are speaking today, this is February 22nd. I think we just came off basically a 6.5 week bear market rally. I think the slide back into the bear market probably started with yesterday's big sort of nasty down day. Today was a little bit of a blip of an update, but I think we're in a bear market. I mean, to summarize, we had over a decade of 0% worldwide interest rates and central banks collectively printing hundreds of billions of dollars a month, right? And now we flipped that around to, at least in the US, nearly 5% interest rates. They're going to be 5% very soon. And quantitative tightening of $95 billion a month. And of course, the ECB is going to start quantitative tightening. And this new maniac, who's running Japan, who left, the old maniacs retiring, even he's going to have to be a little bit tighter with the money. The point is that, we had a decade to build this gigantic asset bubble on free money and money printing. And now it's the reverse. I mean, there's no way asset prices can withstand that. They weren't built for that, So yeah, I think stocks are going, at least in the U.S., which is what I follow. I think stocks are going considerably lower. I think we're just going to grind our way down, throughout later this year, maybe into next year. And then who knows? They may not bounce back so fast either. I mean, you're a young guy. All you've ever seen is either bull markets or very short bear markets. But even the bear market from 2000 to 2003 was a pretty long one, right? It was probably 2.5 years. I think I'd have to look at a chart. But we've had long periods when stocks did nothing. We've had a decade or more when stocks did nothing in the past. I think from like the 30s, 1930s through the 50s, if I remember right, there was a period. So, I don't know that things are going to bounce back. Maybe they will. I mean, central banks now consider it acceptable to print money, and that will drive up asset prices at some point. So I'm not making a long-term prediction here, but my medium-term prediction is a bear market that grinds its way down but has some rallies in it similar to one we just went through.
Yes, I guess what you're saying is the Fed have basically been tightening, and that they're causing a recession, and that's going to have this impact on earnings. And a lot of these companies that potentially looked like they were growing, they're not going to be growing as much anymore. Their capital is going to be a lot more expensive, so it's going to
they haven't been. Yeah, I mean, they haven't. I mean, earnings have been terrible this quarter, certainly relative to the way stocks are priced. And I mean, if you annualize, even if you want to use operating earnings rather than GAAP earnings for the year 2022, the trailing 12-month figure, inclusive of the quarter that's just almost being done reported, which was Q4, the number was somewhere in the high 190s. And, I think a 15 multiple on that PE multiple is reasonable because A, they're operating earnings, they're not GAAP earnings. And B, things are getting worse from there. We have higher rates than we had in 2022. We've got tighter money coming than we had in 2022. So you put that together, that puts the S&P 500, below 3,000, somewhere in the 28 or 2900s. And, that's almost my high-end target. I could see it being considerably lower than that. I mean, in the past, someone actually posted, I'll remember who it is, but he posted a graph of inflation rates versus PE ratios for the S&P 500. And historically, when inflation was, 4 to 5%, which is what we're probably heading down to right now in the US. Right now, it's over 6%. The S&P 500's PE ratio was like 12. I mean, if you put a 12 multiple on 2022 earnings, you've got a disaster compared to what people are expecting. So that's what I think. That's why I'm bearish. I think high interest rates and quantitative tightening will crush what is still a very expensive stock market.
Yeah, it makes sense. And I guess you could say, you mentioned there 10 years of low interest rates. That's really pushed most investors across the risk curve. And now we're seeing, I think I saw the other day that 1 year US bill is about 5%.
6 months.
Yeah.
6 month treasury bill, maybe the 1 year, but yeah, you can get a 6 month treasury bill yielding 5% in this country. Why would you need, to take the risk of stocks? I mean, the dividend yield on the S&P 500, I think, is below 2%. I think it's 1.8 or something like that, 1.9. I have to look. But yeah, you can get guaranteed money, no capital risk in, what I think is going to be a tough stock market. So, for a decade, probably for as long as, how old are you?
27, 28.
27. So probably for as long as you've been following investing, the expression was TINA. There is no alternative. And now it's TIAA. There is an alternative. There's a 5% 6 month T-bill.
Yeah, which makes sense. So when you sort of predict that that the price of, I guess, the S&P and overall markets going to go down, are you thinking that this could be a few of the massive giants such as Amazon, Apple, Microsoft that are really going to be leading the way, or do you think this is going to be an overall market?
I'm looking at. I'm not talking about specific companies here. This is a very general statement I'm making. So I don't know who's going to lead it down. There are some companies that are cheap. I mean, look, I own Stellantis, the auto company. Stellantis this morning reported unbelievable free cash flow and earnings to the point where last I checked, it's basically selling at 2.5 times earnings net of the cash, because it's got a lot of net cash. I mean, it's selling at 2.5 times free cash flow on an enterprise value basis. So I'm not here to pitch Stellantis. I mean, for all I know, if the bear market grinds on, it might take Stellantis down, and maybe it'll go from selling at 2.5 times earnings to 2 times or 1.75 times. Who the hell knows? So I'm just saying generally, I think cash is a better place to be than stocks generally as this plays out. And yeah, I think it'll play out over the next year to 18 months. And then I don't know what happens. I mean, eventually stocks will go up because eventually you get inflation and stocks are priced nominally, as are asset, prices in general. So yeah, I mean, I'm pretty damn sure that 10 years from now, stocks will be higher than they are today in nominal terms, right? Maybe in 5 years, certainly in 20 years. But I don't know how long it takes to get there. There's just so much debt and things just got so crazy. I mean, all these nonsensical asset classes that were invented. I mean, NFTs, cryptocurrencies. I mean, sneakers. I mean, it just got, people buying new luxury watches at massive premiums over list price because they couldn't wait to get one. I mean, all that stuff is going away, right? Some of them is completely gone away. So, there's a lot of excess to be wrung out, as they say.
And I guess what would have to occur for this maybe not to happen and the markets keep going up? Do you think that would need a Fed pivot or?
Well, here's the thing. I mean, people say Fed pivot. First of all, it depends how you define pivot, right? To me, pivot is slashing interest rates. Okay. If the Fed gets to 5%, or now I think expectations are it's going to get to 5.25% and then halt. Okay. That's not a pivot. That's keeping money tighter than it's been in 20 years, right? And doing it for 6 months or a year, that's not a pivot. But the thing to keep in mind is when stocks started crashing from the big internet bubble beginning in March of 2000, the rate of inflation was like, I don't remember exactly, but it was something like 3% the first year, and then like in the 2% range, and then maybe the 1% range, something like that during that bear market. So, they had low CPI numbers coming in, and stocks were still crashing and grinding down and going lower and lower. So that's not going to be a savior here. I mean, if we start printing annual CPI at whatever 3.5%, which I don't think we're going to get there, but we could. It's not going to save stocks if assets got so expensive and there's so much debt out there, and profit margins are compressing because you have to pay your employees more, and profit margins grew for years and years and years to an unsustainably sort of artificially high level. I mean, all this stuff has to play out. So if the Fed pivots and says we're going to stop raising rates, I don't think that's going to save things. I mean, yeah, it might kick off a nice rally for a day or a week or a few weeks, but to me, depending on where stocks are when they do it, that could just set up, another shorting opportunity. I mean, if the S&P gets down to the 2900s or the 2800s or something, and then the Fed says we're going to start cutting rates, yeah, that's a different story. If stocks are starting at a low enough level, but they're not at a low enough level now, for sure, in my opinion.
Yeah, it's really interesting. So I guess for the companies that you're looking to invest in at the moment, they're the ones, as you said, that have strong balance sheets. I guess probably low debt as well is probably a good thing, so they don't have to refinance to these high rates, and then free cash flow. Are those the key things that you're currently looking at?
Well, I'm a value guy, so yeah, I mean, I always look for that. I always look to buy revenue cheaply, and I have a small fund, so I can do micro caps too. I just haven't found much value lately in micro caps. I'm sure I will before this is all over, and I'll go back and I'll probably own a bunch of them. But yeah, I mean, I'm always looking for value. But there are times when there was a lot more value out there, and there are times when there's less, and I'm not seeing a lot of it now. I mean, because earnings are coming down so quickly. So as I said, the only place I'm seeing it is those auto OEMs like Stellantis and Volkswagen. I mean, if you net out Volkswagen's ownership position in Porsche, you basically get the whole rest of the company for free. I mean, Audi alone is probably worth 40 billion euros, right? And it's gonna IPO Lamborghini for 15 billion euros, and it's got Ducati, and it's got the Volkswagen brand itself, and it's got the trucks. That's all free because it owns 75% of Porsche. And it's not as if Porsche is a bubble. I mean, I haven't looked in a week, but when I last looked, I'm talking about the new IPO of Porsche, it was selling at like 15 times earnings. And it's got, it's a luxury good, essentially. I mean, it's got margins off the charts for the auto industry, right? So it was kind of reasonable, maybe fully valued, but fairly valued. And so I own Volkswagen, for that reason. Also, it's selling at whatever, like 4.5 times earnings or something like that. I own Stellantis for the reason I said earlier. I own a smaller position in General Motors, which isn't quite as cheap as the others, but it's still like, 6 times earnings and doing all kinds of stuff with electric cars. And I'm short a ton of Tesla. I mean, basically it's not set up that way deliberately, but it's kind of a paired trade for me to be long these OEMs at 2.5 to 6 times earnings, and short Tesla at what now is probably 70 times the earnings it's going to make this year. And I mean, that company's a disaster. I mean, we can talk about it or not, but they've had to slash prices massively. They're probably making half as much in profit per car this quarter than they made last quarter. And the sales aren't that much better. I mean, they're better here in the US because we have this new tax credit, but Europe's going to be terrible this quarter. China's already being terrible this quarter. And it's 70 times earnings. It's not, I'm looking at it now on my screen. It hasn't been trading on logic. It was starting to trade on logic and it got all the way down. And then the crazy call buying action came in where people were, literally spending, hundreds of millions of dollars a day on calls expiring at the end of the week. And that will drive up a stock. And that's what happened. It became a momentum play again. Now maybe the momentum is killed. We'll see,
Yeah, definitely. And are you ever concerned? Because I guess from you mentioned that I'm sort of like a young investor. I've been in the market probably not that long, seen I guess the 2020 bubble and a lot of the meme stocks that occurred, and it's almost as if there's like a bit of a cultural revolution in terms of investing, and there's people get attached to these names and then they just buy them no matter what's happening. Are you concerned that maybe you're looking at Tesla from a valuation perspective, but there's a lot more involved in terms of emotions and other factors than that?
That's a great question. The answer is I'm not particularly concerned. And the reason is, there are 3.2 billion shares outstanding. We're looking at a market cap of what, $640 billion, right? You can't really keep something that big propped up, certainly once the overall market turns, which I think it's doing. And I think that's what'll, Tesla will go down 3 times as fast as the market, just as it went up 3 times as fast or whatever. I'm making that number up, but obviously it's very high beta, relative to the NASDAQ index, let's say. So I think it's just too big. I mean, you could have a several $100 million, whatever movie theater chain, right? Or Bed Bath and Beyond store or whatever, or GameStop, whatever that, and it can do crazy things because it's small enough that massive retail buying can do it. I think it's harder on Tesla. I mean, obviously it's the most popular retail stock worldwide. Somebody posted on Twitter not too long ago a map showing like in every country in the world, the most popular stock, and probably 80% of them, I'm making up a number, but that's not far off. The most popular stock to trade was Tesla. And these are countries, all over Europe, Asia, whatever. So there are a mass of people, but it's not retail that suddenly comes in and plunks down $20 million at one time for a slug of call options. That's a momentum-driven quant fund of some kind. And those guys will turn around and go the other way, and they'll plunk it down on put options as soon as the momentum's gone and the market starts turning. And, we saw that yesterday in Tesla. It was down a lot. This morning it was down a lot. Then it came back and to being up a few bucks. But that's just like these reflexive dip buyers come in because they've been doing it for so long and getting away with it. But those people all got destroyed when the internet bubble, ground down. And I remember those days, and they had their favorites, companies you never heard of, but CMGI or whatever, and or even Amazon at one point. Amazon was down. You might not know it. Amazon was down at one point 95% from its internet era peak to its trough. But anyway, so these people would come in and, oh, it's down 10%. It must be a bargain. So they buy it, and it would pop 2% and then drop another 10%. So these people need to just sort of be wrung out of the system. The dip buying, the thing's not going to be over until the dip buying finally ends, until people get burned too many times, and it'll happen. It always happens. So, boy, I see Nvidia is now soaring. They must have said something on the conference call. It's up a ton. Interesting. But anyway, so yeah, so it's not happening tonight, but it will happen.
Yeah, it happens sometimes. That's super interesting. So from your perspective, it's really just a value play that you're looking at numbers. It's just way too overvalued that it just has to.
You're talking about Tesla?
Yeah.
Well, Tesla is absurdly expensive considering that technology-wise, it really now has trailing edge electric cars. And without going too far into the weeds, there are cars that charge faster, that have much nicer interiors, that have the same or better real world range. Because Musk, he started off with a great head start, but that doesn't mean anything in the auto business. I mean, every single thing in your car that you have today was somebody's exclusive, option for about 4 years until the cycle came through and everybody else had it. Automatic transmissions, air conditioning, a radio, power steering, power brakes, airbags, stuff that you, especially at your age, just take for granted. And really, I do too, because other than airbags, I grew up with all those things also. But at some point, nobody had them. And the first guy who had power steering was like, oh, get your wife this car with power steering. And it was probably a big hit. And then in 4 years, everybody had it. That's the way the auto business works. And this is no different. And especially in this case, Musk did not reinvest innovation money in Tesla. I mean, he's got the same products that are just aging now. So, yeah, it's expensive, but then also, there's just a lot of blatant fraud that's gone on there. I mean, with his so-called full self-driving program, it's been proven that he used a fake, video segment to market that thing. And the solar tiles, it's been proven that when he showed them, they were actually fake. And so eventually this stuff's going to catch up with him. But even if it doesn't, just the competitiveness of the auto industry is going to catch up with Tesla. And that's what's going to happen.
Yeah, it's interesting. So you don't really put any value on, I guess there's the AI technology, the self-driving. There's also there.
Come on, it's nonsense. The AI guy, I mean, their self-driving is just garbage. Any expert can tell you that it's garbage. You can't do it just with cameras. Okay, that's why everybody else uses LiDAR and radar. And Musk is stuck there too. He doesn't want to spend the money for LiDAR. Supposedly, he's got this new hardware coming out that'll have radar. But then guess what? You have what? 3 million cars on the road that you swore were full self-driving capable, but they don't have radar. Or maybe it's 2 million, because he had radar for a while and then he pulled it out apparently to save money or because of the supply chain problems or whatever. So, yeah, I mean, the whole thing is just a nonsensical promotion, and eventually the lawsuits and the regulators will grind that down. But in the meantime, go look at the dashboard or the interior of a Hyundai, Ioniq 5 or the new Ioniq 6 or its twin, the Kia EV6, or even a Ford Mustang Mach-E, or in the higher end cars, the Mercedes, EQS electric or the EQE electric, or the Porsche Taycan. I mean, you can't even compare them. That's why Tesla, or even in China, the newer, more innovative homegrown Chinese cars like BYD just came out with some higher end cars, and the Neos and the Xpeng. I mean, Tesla just looks like garbage next to those cars, which is why it's losing market share everywhere. And that's why he had to slash prices to the point where, the profits are going to be severely compromised. Those margins everyone used to brag about, they don't exist anymore when you slash prices the way Tesla has in the last few months,
Yeah, well, he's done pretty well, pretty good at extracting value out of the company anyway. So
well, yeah, he's done good at lining his wallet, but he also did well at annihilating, whatever, $30 billion worth of equity value in Twitter. So, what the Lord gaveth with one hand and took it with the other, or something, So yeah.
Yeah, very true. So what would you say is your target price for Tesla?
I mean, Tesla, BMW sells 2.5 million cars a year. Okay, at very good margins, better margins than Tesla is going to have this year and from now on because of the way it slashed prices. I mean, Tesla, its own guidance said it would sell 1.8 million cars this year, and he said, well, maybe 2 million. It's starting to not look that way based on this quarter. But even if he sold 2 million cars, what is that, 80% of the size of BMW, which sells 2.5? So, last I looked, BMW was around 60 billion euros or something. I mean, if you put 80% of that on Tesla, be 48 billion euros, which is what, about, I don't know, 52 or 53 billion dollars, and it's got 3.2 billion shares outstanding. So you're looking at, I don't know, $17 a share, maybe. I mean, that's what the damn thing is generously worth, because it's not really growing much anymore. I mean, not against Q4. You can take the beginning of last year when it was still growing quickly, but that's not happening now. So, $17, $18 a share versus $202 right now. That's a hell of a lot of downside, right? That's over 90% downside. I think we're going to see that.
Yeah, it's crazy to think. So, are there any other companies that you're watching that you think are at exuberant prices that you wouldn't go long?
Well, there's a lot, but I'm not short any other specific companies. I'm short a lot of SPY, a lot of the S&P 500, just to eliminate, specific company short risk, and then I'm long some of those autos, but which I mentioned, but we're very net short right now, like hugely net short, mostly SPY. I mean, Tesla is a big short position for us, but SPY's even a much bigger short position, and we're net short because of that. So, yeah, I mean, I'm bearish, but look, I think you told me that you have a lot of sort of younger investors watching this. I do not recommend that anybody out there short stocks. It's very difficult to do. You get fierce rallies. You have to have a certain mentality to deal with it. A certain cold-blooded confidence, let's call it. And even if you have it, it's hard to make money shorting stocks. I mean, because over time, stocks go up just because of inflation, right? When you short something, you're shorting it in nominal terms. And in nominal terms, over time, things go up. I feel we have a window here, which is why I'm very short, this sort of window where things got very expensive and yet central banks are running tight money. And I think things are going to come in a lot. But overall, my advice to anybody right now is, maybe go to cash, take advantage of that 5%, T-bill for 6 months and see what things look like then, because I do think things will be a lot lower. Don't be so quick, to jump in. I mean, if something is cheap on an absolute basis, then by all means buy it. Because look, I could be wrong. Maybe we are starting a new bull market, and if I'm wrong, so, that's why I'm long, Stellantis at whatever, 2.5 times free cash flow, 2.5 times earnings. That's why I'm long Volkswagen for the reason I described. I mean, it's so damn cheap that, yeah, it could go lower, but if it goes lower, I'm just going to buy more. That's very different from a relative valuation. That's very different from, company XYZ was selling at 45 times earnings, and now it's, now it's at 28 times earnings. It must be a bargain. That's a relative bargain. I personally don't buy things because they're cheaper than they were. I buy things because on any day, under any conditions that I can imagine, it's cheap. And if it fits that bill, I'll buy it. And if it goes down, I'll add to it, assuming the story hasn't changed and everything else is constant. So, but if you're not seeing things that are just cheap on an absolute basis, there's nothing wrong with going to cash. Cash is now an asset class when you can get a guaranteed 5% on it,
Yeah, definitely. It's a lot more stable than what we've seen over the past 6 months or so. So, if we look at your, as you said, you're net short at the moment, what would have to change for you to maybe switch that and go net long? What are you looking for?
Well, the indexes would have to be a lot cheaper than they are, or I would have to be convinced that the economy is going to boom with no inflation. I'm not seeing things that convince me of either of that. But as prices get lower, I take some of the short off sometimes, or at the very least, I don't add to it, so it becomes a smaller percentage of my portfolio. But I'm sure I'll be taking some off at certain times. I mean, I've traded this bear market. I mean, I was very short at the beginning. I covered some, not too far from one of the bottoms. I waited for a rally. I put a bunch back on. I covered it again, put a bunch back on. I mean, and so I'll have a core position, and then I'll make the position a lot bigger if I think the bear market rally is sort of getting out of control. And I'll look at short-term sentiment indicators for that. I mean, if all of a sudden everybody is extremely bearish, I'm going to take some off, because you're probably going to get a rally from there, right? But if on the flip side, if all of a sudden, like the CNN fear and greed indicator, that's a good a great, usable, useful, free indicator that updates all day long. If all of a sudden, as it did 2 weeks ago, if that goes, or last week even, if that goes into extreme greed, and I think we're in a bear market, boom, I'm going to get a lot shorter, But, again, my advice to anybody out there is don't get short. If it gets into extreme greed, go back to cash, maybe, wait for it to, wait for things to settle out one way or another. Either the market, stabilizes for a while and the greed factor comes down, or you can see better prices, one or the other.
Yeah, it's a great message. So, you've mentioned that you're quite heavily in auto at the moment. Are there any other industries that you're currently watching that you think if they do get to that level?
I'm not. I mean, I do think that, I think we're going to have higher oil prices, but I have no positions there. But if somebody said to me, yeah, oil, I mean, obviously you're probably more Brent oriented over there, but we use WTI, and, oil now is, $74 a barrel here in the US. And yeah, I mean, it does sort of seem that it's going higher. But there's nothing else I'm seeing that's, that's 3, 4, 5, 6 times earnings. And I think the earnings are, somewhat sustainable. I mean, look, auto companies are not going to make this year what they made last year, because, last year they could have all sold 20% more cars than they did. They just couldn't get the inventory because of the supply chain issues. That's resolving. They'll probably have to start slapping some more incentives on the cars. and so they'll earn probably less this year. So, maybe something that was 2.5 times last year's earnings will be 4 times this year's earnings at the current price. I mean, they're still so damn cheap. They're priced. Part of it is they were priced to go out of business because all these people were like, oh, Tesla's going to put them out of business, But, the fact is, the new electric cars that GM has coming out this year are probably nicer than any Tesla. For sure, the stuff that Porsche and Audi makes, are nicer than any Tesla, So Mercedes, same deal. The Koreans, same deal. I would have loved to have bought, actually, because I saw what was happening with the electric cars from Hyundai, the Kias and the Hyundai Ioniqs. I would have loved to have bought that stock. It was dirt cheap. It might still be, but it's really, really hard to buy a Korean stock. You actually have to have an account with a local Korean broker, I think, in order to do it, at least from the US. And, that was just too much to set up for just own one stock. But, I would have bought that one too. I mean, none of these companies are going to get put out of business by Tesla. Tesla's the one slashing prices, in order to try to keep up the growth story, even though they're going to have earnings contraction significantly this year, because there's no way they're selling enough extra cars to make up for those price cuts. So, yeah, so that's how I'm positioned.
Yeah, I think there's. I know someone actually bought a Tesla, I think last week, and they're picking up this week as well. So it's a bit different to the 18-month wait time.
Well, you can get it right away in most of the world, and again, the prices are so much lower. I mean, they've gone down market. It's no longer a cool person's luxury good. I mean, if you're buying a Tesla today, you are not cool. You just think you're cool. The cool people are moving on. They're buying other EVs. Actually, one of my favorite EVs that I've driven, and it just never really caught on, is the Jaguar I-Pace, which I think looks terrific and it drives really well. I drove it. I mean, I'm not generally an EV fan just because they're heavy, and also they're a pain in the ass on a long trip. But I love the I-Pace. I mean, if I had to have an EV, although technologically it's a little bit behind because it doesn't charge as fast, and the range is sort of mediocre, but it is pretty cool. But there's just so much stuff coming out now, which again is just nicer than any time. That's why he had to slash the prices, because he knew it. So
yeah, it's a lot more competition. It's going to be harder for them. So Mark, thanks again for your time. I really appreciate it. So I guess my last question is, what is one message you'd like people to take away from our conversation?
When you buy a stock, look, this is sort of a cliche, but it's true. You're buying a share of a business, okay? And before you ever buy a stock, or for that matter, sell a stock, come up with a methodology for what you think it's worth. And I mean, you would not buy a car or a house or a new television set or a new iPad without doing your homework and figuring out what it's worth. And yet there are people who will buy company X at $80 a share because it used to be $100 a share, and so it must be cheap at $80 a share. No, start from square one, figure out what this company is worth, and then figure out what a discount to what you've decided it's worth would be and pay that price for it, whatever it is. It might bear no relationship whatsoever to where the market happens to have it priced on any particular day. But to do that, it requires understanding how to read a balance sheet and a financial statement. And by the way, it's not that hard. I'm self-taught. I taught myself, just reading this through books years ago. I didn't go to business school for it. But that's the way to invest over the long period of time. I mean, the alternative is, yeah, I mean, if you're some sort of a quant computer momentum genius, I guess that's a different way to make money in the market. That's not me. But if you're just a human being, learn how to really evaluate a company, and then you'll know if you're paying a good price for it or not. That's my best advice.
Yeah, I think that's a great message to take away. So, Mark, thanks again. If anyone wanted to find out more about your work, what you do, where would the best places for that be?
Well, you can follow me on Twitter. My Twitter account, I'm very active on Twitter, at least until Musk bans me one day. My Twitter account is probably about a third Tesla, probably about a third other financial stuff, and then a third, just sort of making jokes about what's going on in the news. I mean, I'll see stories and throw stuff up there, and a lot of them are sort of the politically incorrect jokes that people are afraid to make now because they don't want to get fired. I don't have a boss. I work for myself. There's no one to fire me. So, and my Twitter handle is basically the name of my fund, which is at Stanphyl Cap, and that's spelled STANPHYL CAP, at Stanphyl Cap. You can follow me on Twitter, and hopefully I can be useful for you.
Perfect. I'll put that on the
description. Or at least make you laugh.
Yeah, one or the other. But I think we might need it if what you're saying comes true.
Yeah,
bit of laughter. But yeah, thanks again for your time.
Thank you very much. Good luck to you and to your audience.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.